Good morning and welcome. I'm Josh Lipsky, Senior Director of the Atlantic Council's Geoeconomics Center, and welcome everyone watching around the world to the first Geoeconomics Center event of 2024. And we start the year, as we always do for the fourth year running now, in our annual tradition by talking about the global macro outlook for 2024 and beyond. And I am so pleased to welcome back Jan Hatzius, Chief Economist at Goldman Sachs, Head of Global Investment Research. Jan, thank you for being back with us.
It's great to be back with you, Josh. It has become a cherished tradition, and I've been looking forward to this.
I know we've had a lot of people who are looking forward as well, so we're going to jump right in. We have about 45 minutes. We're going to cover as many regions and topics and issues as we can. We want those listening and watching to participate as well. So you can submit questions, askac.org. I'll get to as many as I can. But Jan, let's start in the U.S. So a year ago, we were together at this event, just roughly around the same time. I think it was January 11th instead of January 9th. I looked back at the video, and you said that a soft landing was possible, and you were outside of the mainstream on that, and I pressed you on it. We went back and forth a little bit of why your outlook was more bullish than others. And I think you had said U.S. GDP growth at 1%. We ended up getting around 2.4 in the U.S., so it's surprised to the upside, but you were still closer to that than a lot of forecasters. What happened over the past 12 months here in the U.S.?
So I'd say, first of all, GDP is only one indicator of how the economy has been doing and the strength of growth. GDP indeed came in significantly higher than what we were forecasting. If you look at other indicators that purport to measure the same thing, for example, gross domestic income, which is conceptually equivalent, but there are basically errors and omissions that account for differences between the two. GDI is probably going to be about flat. The Commerce Department basically says you should take an average of those two if you want to estimate how quickly real output really was growing. That was a little bit more than 1%, that average. So I think it's pretty close to the forecast that we had a year ago. I also would note that if you look at labor market indicators, that's another way to figure out whether the economy was growing at an above trend pace or a below trend pace. Labor market indicators would say approximately trend. The unemployment rate is approximately unchanged on a 12-month basis. Now, why have things gone better than I think many expected? Why didn't we get the recession that was the consensus forecast for 2023? I think the main reason is that this is a very different business cycle from other sort of demand-driven, inflation-driven, Fed-driven business cycles. The high inflation of 2021-22 was really driven by, post-pandemic imbalances, importantly on the supply side. Not all supply-driven, but just a really post-pandemic inflation that was much easier to bring down to more reasonable levels than what we had in prior cycles that informed people's expectations. So I think that's the main reason why the economy was able to bring down inflation without a big spike in the unemployment rate and without a recession.
Yeah, and that's what we talked about last year. Is it a year that doesn't fit into different business cycles in recent memory? And we go back to previous post-World War II cycles that maybe feel that they're a little more parallel to what we're dealing with. So what about the year ahead? Once again, you're above street consensus. I was just looking at your outlook. A great title, Hard Part is Over, which we certainly hope is true. So we'll talk about that in this conversation. For the U.S., you're projecting 2.1% GDP growth. I think consensus on the street is 1%. So why, once again, above the consensus?
Basically because I see no particularly good reason why the economy should grow at a below trend pace. I mean, the consensus forecast is, again, below trend growth. And in fact, the median forecaster still has a very elevated risk of a recession. In the Bloomberg survey, the probability of a recession in the next 12 months is still 50%, actually. The median forecaster says 50% recession probability. But I don't think there's a good reason for having a recession forecast or even a below trend growth forecast anymore, because there are some important supports to growth. I'd say, real income, with inflation having come down very significantly and wages still growing at a decent pace, real income is likely to grow something like 3% in 2024, not as rapid as the 4% that we saw in 2023, but still obviously quite solid. Financial conditions are likely to be neutral or even slightly positive in terms of the impulse to growth. So I don't worry about the long and variable lags of past monetary tightening. Those did feed through, the monetary tightening did feed through to tighter financial conditions in the first 3 quarters of 2022, but that was a long time ago, and the negative impulse to growth played out in late 22, early 23. Now financial conditions are, have been effectively stable, if not been easing over more than a year, and I think that's going to be supportive, or at least not a negative on growth. And then again, most importantly, the Fed, if inflation is on its way back to 2%, as I believe it is, we're moving back to 2% pretty quickly. In that sort of environment, the Fed has no incentive to squeeze the economy, run the risk of a recession, or even deliver below trend growth. And so I think they're going to do what is needed to keep growth somewhere around a trend pace. Maybe we'll even get something a little bit above a trend pace. But I think meaningful below trend growth, in my view, is just not the most, it's just not a very plausible forecast. It could happen. Of course, there are shocks. We could be hit by shocks. So I don't rule that out. But is that the most likely outcome? No, I think the most likely outcome is that we'll get something pretty close to a trend growth pace.
Well, you raised the Fed, and that's where I wanted to go next. And you saw Chair Powell at his end of the year conference in December seeming pretty optimistic, as he should be given the year. I think the Fed went through and where they started 12 months ago and how this year could have panned out. Where are you on the Fed and rate cuts? Do you think a March cut is likely? And maybe more importantly, where do you think Fed funds rates end up at the end of the year when we're talking 12 months from now?
Well, we do think cuts are coming, and I think they're probably going to be coming relatively soon. Our baseline is, in fact, that the first 25 basis point cut gets delivered in March, and then we have a total of 5 cuts in 2024, which would take you down to 4 to 4.25 by the end of the year. And then we've got another 3 cuts in 2025. That takes you to 3.25 to 3.5 by the third quarter of next year. And the driver of this is really that inflation is coming back to 2%. Chair Powell said in the press conference that they would want to, even if the economy holds up fine and growth is okay, they would want to normalize the funds rate. And they would not want to, and they would want to start cutting well before the inflation was actually back down at 2% on a year-on-year basis. That, to me, is pretty important when combined with the inflation numbers that we're seeing. Over the last 6 months, core PCE inflation, if you take just the 6-month annualized rate, has been running at 1.9%. The year-on-year rate is still 3.2% as of November, but in our forecast, this comes down to 2.2% in the second quarter, and that basically means they really need to get going, probably sooner rather than later. Obviously, they're not cutting at the end of January, but March, I think, is a reasonable time frame for when they might start, although it could take somewhat longer. I mean, I think May is also possible, but I think March is actually the more likely of the two under our forecast, even with the economy still growing at a 2-ish% pace.
Yeah, so I mean, just to put in perspective what you're saying about the U.S., GDP above trend or on trend growth 2% roughly in the U.S. Inflation back to roughly 2% in the second quarter, and the Fed starting to cut in March. I mean, it's basically as good a scenario as the Fed could have hoped for from a year ago.
Yes, absolutely. I think things have gone very, very well, despite some of the significant turbulence that we saw during the year, including the banking turmoil in March and April. This did not derail the expansion, and we're seeing a soft landing, really driven by the fact that this is a different business cycle, and there's still some benefits from that haven't quite shown up in the data yet, but are unfolding relatively quickly.
So that's what I want to talk about, derailment. What could derail it? You said Bloomberg consensus around 50%. I think you're much lower on the recession odds. But what could go wrong? What's the downside case here?
Yeah, so our probability for recession, NBER defined recession over the next 12 months is 15%, which is basically the long-term average, in the sense that there's been a recession once every 7 years in the post-war period. And that 15% is an estimate that we've had since, I think, September. But if you go back a year, we were at 35%. Consensus at that time, I think, was 65%. Our number was 35%, so meaningfully lower, but still pretty elevated. And it was elevated because while we thought that we'd be able to bring inflation down without a recession, we weren't fully confident of that. There was a possibility, meaningful possibility, that it would take a recession to bring down inflation. That 20 percentage points, the difference between 35 and 15, that's sort of been squeezed out of the of my probability, and that leaves me with what I would maybe label more sort of exogenous shocks. You could say unknown unknowns. You put probably large geopolitical shocks in there, large commodity price shocks, maybe related to an expansion of the war in the Middle East, things like that, and then genuine unknown unknowns, things that can come out of thin air and put an economy into a recession. Of course, the most extreme example of that in recent memory is COVID. So I'm pretty unlikely, I would say, to lower the 12-month recession probability significantly below 15%, because the world's just a pretty uncertain place, and there are lots of things that could go wrong, even if they're not clearly signaled in the current data flow and the current economy.
Is it fair to say, Jan, that in that 15%, a large part of it is driven by geopolitics, is what you're saying, as opposed to macro fundamentals? What do you think about the risk of recession, external exogenous, but not macro geopolitics that then spills over into the macro?
A significant part, yes. I think that is fair to say.
Okay, one last question on the U.S., and then we'll turn to the Eurozone. But we can't not talk about the election when we talk about 2024 in the U.S. How do you price that into your forecast? Is it impacting market volatility later in the year, or do you feel like it's negligible from an economic perspective at this point?
I don't think it's negligible. I suspect, though, that it probably is going to have less of an impact on the macro aggregates in the short term. In past recession years, in past election years, we haven't really found strong evidence that the impending election had a big impact on the economy. It's conceivable that there are going to be some effects on sort of sentiment measures, certainly on markets, and of course, market moves can have effects on the economy, the financial conditions. You could have some effects from, for example, negative advertising on consumer sentiment. But in general, I think the effects of the election are going to be a 2025 issue more than a 2024 issue. And there, of course, there are big questions around, what happens to fiscal policy, what happens to the personal tax cuts that expire at the end of 2025, what happens to trade policy. Some of these questions, especially the fiscal ones, are going to depend not just on the outcome of the presidential election, but also on whether one party has full control of Congress. I think if Trump were to win, it's more likely that that would mean unified control than if Biden were to win, basically because Republicans have a pretty significant advantage in the Senate just in terms of the way the map works. But so in 2025 and certainly 2026, who is in the White House and what happens in Congress is going to be extremely important. But I'm not sure it's going to be all that important for 2024.
So this will dominate our conversation next January when we have you back for the 5th year in a row. I think that'll be a key focus of what we talk about. Let's go to Europe. So I want to start with Germany and the Eurozone. Very weak growth. We debated last year whether they'd be in technical recession or not and hovered around it all year. And then this year, I think you have them at 0.5 or 0.6, right around where the consensus is. Can they avoid recession again this year? And how much of a drag on Eurozone growth? And it's even strange to say this, thinking of where we were in the 2010s. But how much of a drag on Eurozone growth is German GDP growth?
So I don't think Germany is going to be able to avoid a technical recession. I suspect Q4 is going to be negative. That would give you, by the two negative quarters criterion, a technical recession. As you know, in the United States, a recession is generally diagnosed by the National Bureau of Economic Research based on a range of different indicators. So it's not just 2 negative quarters. There's no equivalent of that in Europe. So people generally go by whether there are 2 consecutive negative quarters. And Germany will probably meet the recession criterion based number of developments, external developments. The Russia-Ukraine war was a bigger issue for Germany than for other countries, other major economies, other European economies even. Germany has suffered from the weakness in China. It's more exposed to China than most other European economies. And Germany is also seeing a negative impulse from fiscal policy, and the impact of the so-called constitutional debt brake is going to be negative. I always thought that the debt brake was problematic because it is a very inflexible way of constraining fiscal policy, and I think at this stage of the business cycle, it's likely to be unhelpful in 2024. And so we're estimating a drag from just the debt brake of a couple of tenths of a percentage point, and we think that will keep Germany growing at a very weak pace. That said, we do have positive growth in Germany because the rest of the global economy we think is going to come in a little bit stronger than most forecasts, and of course, we've already talked about the U.S. that will have some impact on Germany as well.
Yeah, I was going to ask about the debt brake, but you covered a few tenths of a point, and we'll see how it develops and if it has political impacts in Germany and the coalition. But that's based on what you see now, at least so far, and the agreements they've reached or the compromises. Yeah,
the mechanical impact would be bigger than that, more like half a percentage point. But we think, they'll manage to sort of effectively fudge some of these things. And just to be clear, fudging has a negative connotation, but I actually think this is a good thing because large fiscal tightening is not really the right macro policy prescription for Germany at this point.
Well, what about bright spots in the Eurozone? I mean, we talked a lot about it at the Atlantic Council last year, Southern Europe being bright spot. We looked at Spain. Is that the same story again in your mind for 24?
Yeah, I would say France, Italy, and especially Spain should grow at an okay pace. Probably all somewhat faster than the euro area average of 0.7%, which is already a couple of tenths above the consensus forecast. So we're leaning towards the optimistic side as far as Europe and especially the Mediterranean economies are concerned. What are the drivers? One important driver, I think, is that real income is now also picking up. Real income growth, which was very strong in the US in 2023, is also improving in Europe at this point. The Russian gas shock is moving more, further into the rearview mirror. The drag on real disposable income from the increases in mortgage rates and adjustable rate, the transmission via adjustable rate mortgages, that's now behind us. That's actually been one important sort of asymmetric negative in Europe relative to the US, because Europeans don't have 30-year fixed rate mortgages, and in many countries there is pass-through to the cash flow of current borrowers, but that's becoming less of an issue, especially as the ECB moves towards rate cuts. More broadly, an ECB that is becoming more stimulative is going to mean less of a monetary policy drag. And I think we are seeing some of the improvement in a few of the forward-looking surveys, although you have to squint pretty hard to see something meaningful. So most of this is still a forecast rather than a fact.
Well, you raised the ECB, so let's talk about their rate cut path in your mind. Inflation normalizing in the Eurozone, just as it is in the US, rapidly actually, based on some of the latest data. What do you think their cut cycle looks like throughout the year?
It's similar in our forecast. We have them starting in April. March is a possibility, although the March ECB meeting is actually before the Fed meeting, and my guess would be that they're more likely to go after the Fed rather than before the Fed. But then we have them effectively cutting in a straight line, 25 basis points a meeting, until they're back from 4% to 2.25% in early 2025. So actually even a little bit more aggressively than what we have in the US. And the reason is, the inflation news has been at least as good as in the US, and the real economy is clearly weaker. So the argument for cutting in some ways is even more unambiguous in Europe than it is in the US. In the US, you can have the debate about, inflation's coming down a lot, but does the economy really need rate cuts if we're already growing at a 2% plus pace? That's a, spirited debate that we can have. In Europe, it's all pretty one-sided. The economy is underperforming, flirting with recession, or at least growing at a slow pace, and inflation has come down a lot. So yeah, the ECB, it makes a ton of sense for the ECB to get going relatively soon.
So either way, by late spring, Fed and ECB are both cutting in your mind?
That's our view, and I think the same is going to be true for other advanced economies, central banks in advanced economies. The Bank of England, I think, is also going to join in not too soon, not too long after, maybe, the May meeting. I think the Bank of Canada is going to be cutting, and of course, a number of emerging economies are already cutting. The Brazilians are cutting. I think the Mexicans are probably not too far behind. They haven't started yet. So, we'll be seeing pretty pervasive rate cuts if our forecast is correct.
And final question on Europe. Has Europe weathered the energy storm here? I mean, we looked at last year and we said mild winter. So far this year, I know it's cold streak right now in Europe, but it's been mild before that. It seems like reserves are plentiful significantly through the winter already. Where do you see it?
I mean, we're, I think, getting through the, last few weeks of when something could go significantly wrong. So far, it really hasn't, where the effect, in part because it was mild early on, has been relatively limited. So I think if nothing goes significantly wrong in the next few weeks, then probably it's going to be a pretty small factor on a sequential basis. And on a year-on-year basis, of course, this is still a source of additional strength or a source of support, because year-on-year, you're comparing with what was a very tough winter, 22-23.
Yeah, it's significantly different than what we talked about when I think 2 years ago, Yad, where we got together, the energy issues and the weather issues dominated the conversation, the winter of Europe right after the invasion. So I always think in these conversations, it's useful to look back a little bit and think about things that did happen. And that's certainly one of them. Let's turn to China now. I have a lot of questions in the chat about China. I'll try to bucket them together as much as I can here in the 15, 20 minutes we have left. But let me put it like this. Most forecasters were too bearish on the US last year, and I would say they were too bullish on China. There was a lot of conversation when we got together last year about China's rebound. This is the year post-COVID where China would surge again. It didn't really happen. Official statistics say they will hit 5% GDP growth. We could debate, whether we believe that or not. We do a Pathfinder project with Rhodium Group that really would show that GDP growth is much below that, closer to 2 or 3%. But either way, it's a weaker China than we projected, that I think Goldman projected a year ago. So what happened in your mind over the past 12 months in China? And then we'll talk about the year ahead.
Yeah, we were definitely whipsawed in China. We had a pretty negative view on China through 2022 based on, partly COVID-related issues and partly some of the longer-term negatives around housing and demographics, etc. But then thought there would be, at least for a few quarters, a real V-shaped recovery on the dismantling of the COVID restrictions that came closely into view in late 2022, early 2023, when we were having this discussion. And it just didn't measure up to what we had expected. It didn't measure up to the impact that we saw in other economies when COVID restrictions came off. And so I think that's been one source of disappointment. And I think the longer term negatives have continued to be a problem as we've gone through the year. I think that we have continued to see a pretty meaningful drag from housing. We've seen continued bad news on demographics. Now, admittedly, that's probably not something that has as much of an impact on the near-term quarter-to-quarter GDP numbers. But policy did not turn very stimulative. It stimulated a little bit, but it's just overall been a very lackluster environment. So what we're expecting from here on out is effectively a more of the same, gradually decelerating growth. We're thinking 5.3% for 2023. We have 4.8% for 2024, and then we have ongoing deceleration really in coming years until growth rates in China look more sort of globally normal. But this is happening at a relatively early stage of the Chinese development process. If you look at GDP per capita on a purchasing power parity basis, China is still at less than 1/3 the United States. That's a relatively early stage at which to transition into a slower growth pace. So China obviously has made an enormous amount of progress in terms of boosting living standards over the last few decades. But this deceleration is coming at a point where China is still pretty far from really being a high-income economy.
You mentioned the property sector in 24, and I want to show a chart we did here at the Geoeconomic Center. And basically what this looks over is year-over-year change in lending to the property sector from Chinese banks to the manufacturing sector. And I just wanted your reaction to it. We've been debating it internally, but I think it speaks to some of, obviously, where they see the risk and where they're leveraging. But this has enormous spillover effects. If this is where China is now pivoting their economy in 24 and beyond, we in Europe, we in the US will be the recipients of this manufacturing, I would think.
Yeah, and I mean, clearly we're seeing that in some areas, like, for example, electric cars, where China is rapidly increasing its global market share. There's the question what that ultimately means for for trade policy. I mean, there are obviously there's a lot of demand for trade protection in Western economies. And I think if we do see big increases in some of these areas in Chinese exports, there certainly may be trade barriers that will be put up. But I also think the slowdown in lending to the property sector, I mean, it's a very clear chart, and I think that probably has further to go as well. And we're not yet in the later stages. I think we're still in the early to middle stages of the property market adjustment.
Yeah, I think we'll do that again next year, and we'll see where the change and transition has been. But I agree with you; it's going to dip even further in the year-over-year change, most likely. But what about the PBOC? I mean, do you expect them to be supportive this year more than they've been in the past? And what more could they do?
We're expecting sort of more of the same, meaning, yes, some more additional easing, but not. I don't see a dramatic turn. So we have modest rate cuts in the policy rate, maybe 20 basis points. The triple R rate, the reserve requirement ratio, we think is going to come down. We're expecting some acceleration in growth of total social financing, broad credit aggregate. And on the fiscal side, we're also looking for some additional fiscal stimulus and expansion of the effective deficit. But while there are quite a number of dimensions to the easing of policy in China, it doesn't look to me that this is going to be enough to really turn around what is this decelerating trend of growth. And I don't think, there is more focus on it from the policymakers incrementally, but it's still not the top priority to really go all out in stimulating.
Yeah, no, I think it's important what you said about the decelerating trend, because we get very much in the debates. We'll get the IMF WEO update this week before Davos of where is China's GDP change, 4, 4.5, 5. But the decelerating trend is the big macro issue here. This is what the whole world is going to have to grapple with, not just China.
Yes, right, indeed.
Okay, we have a lot of questions here, and I have a few more I want to get to. Let me ask one, because this touches a lot on our work at the Geoeconomic Center. It's about de-dollarization. So we are, I would say, somewhat de-dollarization skeptics at the Geoeconomic Center, though we take the demand signal seriously. We run a dollar dominance monitor project everyone can check out. But the question here for you, Jan, is many nations, including Russia and China, are on a new de-dollarization path based on the impact of sanctions. We could debate that, but do you see any change on the dollar status as the reserve currency in the near or medium term?
In general, I think this is something that happens pretty slowly. The dollar has, I think, some very important inbuilt network advantages, and I don't really see a competitor to the dollar at anytime soon. I still think that the dollar is going to be by far the primary global reserve currency for invoicing, store of value for private investors. I think that I don't expect any of that to change. But of course, the more kind of global strife there is, the more likely it is that you have additional kind of parts of the global economy, like the China-Russia trading relationship, that will be conducted in other currencies. But I would say in the biggest parts of the global economy, I think the dollar is still going to be pretty unrivaled.
Yeah, we share that consensus here at the Council, though we track it carefully, and because we believe, a lot of this happens in the financial plumbing, the transfer systems, the messaging systems, not just the trade invoicing, and that piece of it is, there are alternative systems being built, but as you say, these take a long time. There are significant network effects that are built around all of them. I have a question here about Argentina. What is the risk of a default at Argentina? Would there be ripple effects macro globally if there was a default?
It's hard for me to assess the risk. It's obviously a situation that's very much in flux with the new team only having been there for a short period so far. They've made some significant changes in policy already. How big would the ripple effect be? I suspect it'd be smaller than in the past, just because Argentina is is a well-known special case. I mean, if you look at most of the world economy, and including most of Latin America, they're in a very, very different spot. And I think the read across from Argentina to other economies probably would be relatively limited. But I don't have a very, very strong view on it, because I think there's still a significant amount of uncertainty.
Now, on the bright side, I have a question here about India. I mean, I think you're projecting, I look at 6.3% GDP growth, a little above consensus. Can India sustain this growth model? This is now a couple years running for them. What are the drivers of growth in the Indian economy right now?
Well, I think the long-term drivers are, of course, demographics, labor force growth, and productivity. And India, for all its problems, and obviously there is a lot of politics in India. We're having a very contentious election this year, but India has a lot of potential because the population is growing quickly, and there have been some significant improvements in financial plumbing, and there's a lot of room for upgrading infrastructure. And so I think the strength in Indian growth that we're seeing is mainly a long-term rapid development story as opposed to a short-term cyclical boom. So I do think that India is well positioned. Obviously, financial markets have recognized that, and we've seen significant improvement in asset valuations, increases in asset valuations. So a lot of that is discounted. But I do think that the long-term growth outlook in India is brighter than in most other major economies.
Yeah, and certainly a benefit of friendshoring and some of the pivots we've seen across the G7 over the past 2 years, which they're trying to capitalize on, obviously.
They've played their cards pretty smartly in terms of the kind of great power rivalries.
Yeah.
So far, at least.
So the question I always ask each year, Jan, the Black Swan event question, which is the impossible question to answer, because if we knew, that it wouldn't be the Black Swan event. But I still have to ask you, Jan, anyway. And last year we talked about geopolitics. I went back in the video and looked at some of the things we discussed. One thing that you and Megan Green, who was with us last year, raised were market volatility, banking issues, and then 2 months later, in March, we got Silicon Valley Bank collapse. So what is the Black Swan event, the low probability event that we should be thinking about, but we're not?
We talked about the geopolitics and just the politics, and the number of elections, which you've obviously looked at closely. Is if it's not a record, then it certainly feels like one. And the amount of political uncertainty in the United States, in many other places. India came up. We've got an election in Taiwan. We've got an election in the UK. We've got an election in South Africa. So I think that is really probably the thing to focus on most. The banking issues in an environment in which interest rates are again coming down, that seems like less of a risk than last year. Obviously, not something that you would ever entirely take off the table, but that was something to definitely talk about in depth a year ago and 18 months ago when central banks were hiking at a record pace. But now that central banks can cut and are likely to cut, it's probably a bit less of an issue.
So I have a question here online. It's about your forecast, your outlook, which you put out, I think, in late November. Is that right, Jan? The Goldman look ahead, the hard part is over?
Mid-November.
Mid-November. Yeah. And so the question here is about, given recent events in the Red Sea in particular, would you change any of your forecast or projections, or are there other reasons that you would change your projections from mid-November at this point?
Well, we change our projections basically all the time, depending on the news flow, and the numbers that we're writing down now are a little different from what we had in November. But at a basic level, I think the story that we laid out in November, the hard part is over. We've gotten most of the disinflation underway. It's no longer really plausible to say that the US economy or DM economies need a recession in order to get inflation down. All of that, I would say, looks the same now as 2 months ago. The one thing that has evolved, I would say, is that the inflation news flow has been even better than what we had expected back then. Inflation and core inflation and headline inflation is coming back down to the target even more quickly. And that's brought forward the timeline for rate cuts from the major central banks. And so the Fed does now look like they're going to cut in March. And if they don't cut in March, probably they're going to cut soon after March. And back in November, we still thought rate cuts wouldn't happen until the second half of the year from the major central banks. But with that exception, I would say things still look reasonably similar.
Yeah, and I mean, that's a significant development that obviously affects everyone's forecast. As you said, in mid-November is a long time away from now, and so much has changed even in the past 2 months. And on the shipping issues and the Red Sea, macroeconomic impacts of that, or you think relatively minor?
So far, I think it's been relatively minor. It's probably a bit more important for Europe than it is for the US, just because of where the supply chains run. We haven't made any major changes on the back of this, but more broadly, Middle East turmoil and military conflict is, of course, always something that you have to be looking at pretty closely. And the fact that we haven't made any changes to our forecasts based on what we've seen doesn't mean we might not have to do this if things spread, especially as far as Iran is concerned.
So speaking of forecasts, I want to get to my final question. We're going to put up one more chart, and this is an analysis we did. It's gaps of forecasting between the IMF and Goldman, and it really just meant to reflect the difference, the volatility we've seen in forecasting. And here it is just over the past few years. And you can go back, and I think it was, this curve basically shows that COVID and others caused a spike in the gaps in forecasting. And so my question for you, Jan, you've done this now a long time. How have things changed as a forecaster from your perspective? Is it a more difficult job than it was a few years ago, given these events that we've all experienced in the past few years?
Before I get to that, this chart takes IMF minus Goldman Sachs, so the IMF forecast is always higher than ours?
It's the gap between the forecasts. So it's just showing the spread between the two. So the spreads have gotten wider between IMF and Goldman Sachs forecasting in recent years.
Oh, okay. There's absolute value.
Yeah. So it's not that you've been more bullish or IMF's been more bullish. It's just the spreads between the two.
I see. Yeah, I mean there are probably some sort of technical issues, like whether you aggregated PPP or market exchange rates that I'd have to look at. In general, has forecasting gotten more difficult? I don't think so. I think forecast errors during and immediately after the pandemic, of course, were dramatically greater than at other points. That's for sure. But one of the nice things about being a forecaster is that you're always making your assessments on sort of a relative basis. You're kind of competing with the consensus. And in that sense, I don't think it's more difficult. In fact, in a more turbulent environment, you actually have more opportunities to add value. Now, obviously, you also have more opportunities to subtract value, but it's actually a sort of exciting environment for forecasters when there is a ton of uncertainty, and therefore forecast errors are likely to be bigger. And we're not called the dismal science for nothing. In that sort of environment, that's actually the time when your job as a forecaster can be particularly exciting, and you can actually really make your mark. But again, it obviously cuts both ways.
Well, yeah, I mean, you've done that in your career. I think back to pre-global financial crisis, you sounding the alarm, and then I think in the recent years, you saying the U.S. would really recover more strongly than many were projecting. So I guess my final question now, I said the previous one was the final, but this really is the final, Jan, is what does it feel like when you're outside the mainstream on these forecasts? When you're maybe more bullish on the U.S. than others, and you kind of go out there, you have to defend it. How does that feel as a forecaster when you're outside the consensus of your colleagues?
It's always a bit scary because, human beings are not really engineered to be out of consensus. I mean, we're sort of, herd animals. It feels safer if you're with other people, and that's what you have to sort of fight, because if you don't have out of consensus views as a forecaster, then you're not really adding very much. And of course, you're not always going to be out of consensus. But I think as a forecaster, you have to try to identify areas where the consensus of markets or of forecasters or of policymakers is more likely to be incorrect, and sort of highlight those. But it's never a comfortable feeling. It gets easier over time. I think once you've got a few successful out of consensus forecasts under your belt, people give you maybe a little bit more the benefit of the doubt, but it's never entirely comfortable, because there's usually a reason why other people have a different view when you're out of consensus, and there are a lot of smart people out there that are making their judgments, and you'll be basically arguing with them, and that can be an uncomfortable environment.
Jan, I appreciate you coming here now 4 years in a row to explain your forecast, to dig into them in depth with us. We get enormous value out of it each year. And what I love the most is coming back each year and reflecting on it, seeing what's changed, seeing what hasn't. And so I just appreciate your time and want to say thank you.
Thank you so much, Josh. And thanks also to the Atlantic Council and the Geoeconomic Center for facilitating these discussions. I always enjoy them enormously.
Well, we look forward to continuing discussion throughout the year and hosting you again next year, which will be the 5th of our Global Outlook events. I want to thank everyone for joining us this morning. Thank you for being part of the first Geoeconomic Center event of the year. Many more to come, including next week, a week from today, where we launch 3 new reports on the future of the Bretton Woods system from our Bretton Woods fellows. We'll drop the registration link in the Zoom chat here. We wish everyone a good day and a good rest of the week.